Raymond paid his property tax bill every January for 40 years. Same amount, never questioned it. Then last year, a county clerk mentioned something in passing, and Raymond found out he'd been leaving $1,933 on the table. Every year, for 3 years straight. That's $5,799 gone, for nothing, because of one form he never knew existed. He's 68. He lives in Fort Worth, Texas. He owns his home outright, and he'd already filed for the exemption he thought covered him. He was wrong. There's a second one, sitting right on top of the first, and almost nobody stacks it. If you're 65 or older and you own your home, this isn't just Raymond's story. There's a real chance your county is sitting on money that's yours, and the only thing standing between you and it is a form nobody mailed you. Raymond missed a second exemption. If you're 65 or older and you own your home in Texas, there are 2 of them, and most people only ever file one. The first is the general homestead exemption. In Texas, that knocks $140,000 off your home's value before the school district calculates what you owe. Almost everyone files that one. It's the box you check when you buy the house. The second exists only for people 65 and older, or people with a disability. It's an additional $60,000 off, stacked right on top of the first. Add them together, and that's $200,000 of your home's value the school district isn't allowed to touch. And that second exemption is a separate form. Filing the first one does not file the second. The county doesn't roll you into it automatically the year you turn 65. Nobody calls, nobody writes. The bill just keeps coming, calculated as if that $60,000 exemption doesn't exist, because as far as the county's computer is concerned, you never claimed it. The Texas Comptroller estimates the average senior saves about $1,933 a year once that exemption is on. That's Raymond's number. Walk it out with me, because a year doesn't sound like much until you compound it. $1,933 a year across a 20-year retirement is $38,660. Nearly $40,000 sitting in your own county's system, waiting on one signature nobody told you to give. Texas has one more layer almost nobody uses. It's called the tax ceiling. The year you turn 65, if you file for it, the dollar amount of your school district taxes freezes permanently. Your home can double in value. The market can go insane. Your neighbor's bills climb every single year. Yours stays locked at the number it was the year you qualified. And that freeze doesn't turn on by itself either. You have to elect it, on the same form, in the year you first qualify. Miss it, and you're paying the climbing bill your neighbor is stuck with. Quick honest note before we go further. I'm not your accountant or your attorney. This is education, not personalized advice. The specifics of your situation, go to a professional who actually works for you. Now back to it. If you're in Texas, do me a favor. Drop your county in the comments, so I can see how many of you are sitting on an exemption you never filed. And if you know someone who owns a paid-off home and turned 65 recently, send them this. That's exactly the person losing $2,000 a year without knowing it. Because Texas isn't even the most generous state on this list. The next one hands seniors a break most residents don't believe is real. Now, a lot of you aren't in Texas, and a lot of you are already thinking, my state has a senior freeze. I've got mine. I'm fine. I want you to stay with me on this one, because the word freeze is doing something sneaky, and it's costing people who think they're protected. Take Illinois. Illinois has one of the most talked about senior programs in the country, the Senior Citizens Assessment Freeze. And on paper, it sounds like exactly what you'd want. You hit the age, you meet the income limit, which just climbed, by the way, from $65,000 up towards $79,000 over the next few years. You file, and your assessment freezes. Done. Protected for life. That's what people hear. But read the actual name of it. It's an assessment freeze. It freezes the assessed value of your home, the number they multiply against the tax rate. It does not freeze your tax bill. That difference is the whole game. Your assessed value gets locked. Fine. But the tax rate? That's set by your local taxing bodies, the schools, the county, the districts, and they raise it whenever they need more money. So the value stays frozen. The rate climbs, and you multiply a frozen number by a bigger number every single year. Your bill goes up, with the freeze active, working exactly as designed. Picture the couple who filed for this 10 years ago, checked the box, and mentally closed the file. They believe their taxes are frozen. They tell their kids their taxes are frozen. And every year the bill creeps higher, and they assume that's just how it is. They did everything the state asked. They just believed a word that promised more than it delivers. I'm not telling you the Illinois freeze is worthless. It genuinely slows the damage, and slowing it is worth real money over 20 years. What I'm telling you is that freeze does not mean what your gut thinks it means, and if you're relying on it as a full shield, you've got a gap you can't see, and other breaks you could be stacking on top. So here's my question for the Illinois folks watching. Did you know your freeze only locks the value, not the bill? Tell me in the comments, honestly, because I'd bet most of you were told frozen and left it there. And if you think that's a strange way to run a senior benefit, wait until you see New York. Because New York doesn't hide one program behind a confusing name. It runs two of them, side by side, and almost nobody claims both. If you own a home in New York and you're over 65, I need you to hear this next part twice, because there isn't one senior break waiting for you. There are two. They're separate programs, run by separate offices, with separate applications, and the vast majority of New York seniors claim one of them and go their whole retirement, never knowing the second one exists. The first one most people have heard of. It's called Enhanced STAR, the School Tax Relief Program. If you're 65 or older and your income lands under the limit, which for the coming school year is $110,150, you get a chunk knocked off your school property taxes. A lot of New York seniors have this one. It's the famous one. Then there's the one that doesn't get mentioned in the same breath. It's called SKE, the Senior Citizens Homeowners Exemption. Different program, different form, different office administering it. And SKE can take up to 50%, half, off the assessed value of your home, depending on your income and where you live. Now let me be precise, because precision is the whole reason you can trust anything I tell you. You'll see some sources online throwing around bigger numbers, 65%, whatever. The real ceiling on SCHE is 50%. I'd rather give you the number that holds up when you walk into the assessor's office than the number that sounds better on a thumbnail. These two programs are not either or. That's what makes it sting. A qualifying senior can hold Enhanced STAR and SCHE at the same time. One reduces your school tax, the other cuts your assessed value. They attack the bill from two different directions, and they stack. So the person who's got Enhanced STAR and thinks they've maxed out their senior benefits, they may be sitting on a second exemption, worth up to half their home's assessed value, that they never applied for, because they had no idea they were allowed to hold both. You did the responsible thing. You found the program, you filed, you got your relief. And precisely because you found one, you stopped looking. The second one, the bigger one in a lot of cases, just sat there unclaimed year after year, while you paid a bill you had every legal right to cut in half. New Yorkers, this is the moment to be honest with yourself in the comments. Did you know both STAR and SCHE existed? Did you know you could hold both at once? Because if this is the first you're hearing of it, you are very much not alone, and that's exactly the problem. And the next trap catches a completely different person, the one who's convinced, right now, that they make too much money to qualify for any of this. That assumption is about to cost them thousands. I want to talk to a specific person right now. You've been watching this thinking, this is nice for people who need it, but I'm fine. I saved. I've got a pension, maybe some rental income, my Social Security's decent. These programs aren't for someone like me, they're for low-income seniors. If that's you, you are exactly the person the next one was built for, and you've probably been walking past it for years. New Jersey has a program called Stay NJ, and Stay NJ is not a poverty program. It's designed to reimburse eligible senior homeowners for 50% of their property tax bill, up to a cap of $6,500. Half your property taxes, back in your pocket, up to $6,500 a year. And the income limit on Stay NJ should stop you cold if you assumed you earned too much. It's $200,000. $200,000. This is not a program for people scraping by. It reaches deep into the comfortable middle and even the upper middle. A retired couple pulling a solid 6 figures in New Jersey can qualify for thousands of dollars back, and a huge share of them will never apply, because they took one look at senior property tax relief and decided in their own heads that it couldn't possibly mean them. And I assumed I made too much is not a filing status. It's just a quiet way to leave the check on the table. Now I have to be straight with you about the clock on this one because Stay NJ is brand new and still moving. The current rules were locked in through New Jersey's budget signed in the summer of 2026. That's recent. Programs this fresh get adjusted, thresholds shift, brackets get rewritten in the next budget cycle. So if you're in New Jersey and this applies to you, the move is not to trust my numbers forever. The move is to go confirm the current figures the moment you're ready to file. Because a program that changed this year can change again next year. But this trap doesn't just live in New Jersey. All over the country, the single biggest reason seniors leave relief unclaimed isn't that they don't qualify. It's that they decided they didn't qualify without ever checking. They ruled themselves out for free. So tell me the truth in the comments. Have you ever skipped applying for something because you just assumed your income was too high? Be honest. Because that assumption is the cheapest, most expensive mistake in this entire topic. And now I want to show you the one group that doesn't get a discount or a rebate at all. They get the whole bill erased, zero. And most of them have no idea it's sitting there waiting. If you served this country and you're rated 100% disabled by the VA, or your spouse is, or was, do not move for the next 90 seconds, because this may be the most valuable thing anyone tells you all year. In 22 states, a veteran with a 100% permanent and total disability rating pays zero property tax on their primary home. Not a discount, not a reduction, not a little off the top. The entire property tax bill, gone. In several of those states, there's no cap on the home's value at all. The property tax line reads zero, year after year, for the rest of your life. Now walk that out against everything else we've covered. In Texas, Raymond's exemption saved him about $2,000 a year. That's real money. But this, a full exemption, is the whole bill. In a lot of areas, that's $4,000, $5,000, $6,000 a year, erased. Over a 20-year retirement, you are talking about a veteran keeping $100,000 or more that would otherwise have gone to the county, simply because of a benefit they earned and a form they filed. And here's the part that makes me want to grab people by the shoulders. A huge number of eligible veterans never claim this. And the reason is heartbreaking in how simple it is. They assume their VA disability rating already handles it. It does not. Your VA compensation and your property tax exemption are two completely separate systems. The VA does not call your county assessor. Your county assessor does not check your VA file. Getting the disability rating does not automatically wipe your property tax. You have to take that rating, walk it over to the county, and file a separate application to turn the exemption on. So you've got veterans sitting on a rating that entitles them to a $0 property tax bill, paying it in full every single year. Because nobody ever told them the two things don't talk to each other. That's a veteran overpaying thousands a year on a home they fought to be able to keep. If you are that veteran or you love one, this is the single most important sentence in the video. Take your VA disability rating to your county assessor's office and ask by name about the disabled veteran property tax exemption. Do not assume it's automatic. It is almost never automatic. And I'm going to ask you to do one more thing right now, because this is where a share genuinely changes a life. If you know a veteran, a father, a neighbor, a friend from the service, who's rated 100% and might be paying property tax they don't owe, stop and send them this video. That one act could be worth more to them than everything else in their mailbox this month combined. But before you go file anything, there's a trap I have to warn you about. Because there's one program out there that looks like a break, sounds like a break, and is actually a loan against your own house. If you confuse the two, it can cost your family the home. Everything I've shown you so far puts money back in your pocket. This next one is different, and I need you to understand the difference before you ever sign for it, because it's the one that can quietly cost your family the house. A lot of states, Oregon, Minnesota, Massachusetts, Texas, California, and others, offer something called a property tax deferral. To a senior on a fixed income staring at a bill they can't comfortably pay, it sounds like mercy. The state tells you, don't worry about paying right now. Defer it. You can stay in your home. And in the moment, that relief is real. But a deferral is not an exemption. It is not a discount. Nothing gets reduced. What actually happens is the state lets you skip paying now, and then quietly records a lien against your home for every dollar you deferred, usually with interest stacking on top. That balance doesn't disappear. It sits there, growing, until the day the home changes hands, when you sell, or more often, when you pass away. And then it lands on the people you leave behind. Your kids inherit the house, the one you wanted to hand down free and clear. And before they can keep it or sell it, there's a bill waiting. Years of deferred taxes plus interest, paid out of the estate first. What felt like the state doing you a kindness turns into a debt your family didn't see coming. I'm not telling you to never use a deferral. For some people in a genuine cash flow bind, keeping the home now is worth the trade, and that's a legitimate choice to make with your eyes open. What I am telling you is this. A deferral is a loan against your own house, not a break on your taxes. And anyone who pitches it to you as free or as senior relief without saying the word loan is doing you real harm. A discount you keep. A deferral your estate pays back. So here's exactly what you do. Not the theory, the phone call. Call your county assessor's or appraisal district's office directly. Not the state, not a website. The county office that actually calculates your bill. And do not ask the vague question, because the vague question gets the vague answer. Ask by name. Ask, do I qualify for a senior or over 65 exemption, and have I filed for it? Ask, is there a separate disabled or disabled veteran exemption, and what's the form number? Ask, is there an assessment freeze or a tax ceiling I need to elect? And is this the year I have to do it? Name the programs out loud. That's what forces a real answer instead of a shrug. Then ask the two questions that protect you on the clock. First, what's the filing deadline for this tax year? Miss the window, and in most states you lose that year outright. Second, if I qualified in a past year and never filed, can I get it retroactively? Because some states, Texas among them, will let you recover up to 2 years back. That's real money you may still be able to claw in, but only if you ask, and only if you ask now. Write the answers down, get the form numbers, file the paperwork, or bring it to someone who'll file it with you. One afternoon of phone calls against tens of thousands of dollars over your retirement. That is the best paying work you will do all year. And if this video showed you even one program you didn't know you qualified for, do the thing that costs you nothing and helps someone you love. Share it with another homeowner over 65. Every person watching this has a neighbor or a parent quietly overpaying a bill they never had to. Now think back to Raymond. 40 years of paying, 3 years of overpaying, $5,799 gone that he's never getting back. But the day a clerk finally said something, Raymond made one phone call and filed one form. And the next 20 years of his retirement look completely different than the last 3. That's the whole difference. Not luck, not income, not some secret only insiders get. One question asked out loud to the right office. The form was sitting there the entire time. It always is. Nobody was ever going to walk it over and put it in your hands. So go be the one who asks. Because the only senior who loses this money is the one who assumed it was never theirs to claim.